partners, all of us have been operators, all of us have worked in businesses, all of us have been responsible for payroll and shipping products out the door and making sure the business of business actually happens. And so we're happy to roll up our sleeves.
Thank you so much for tuning in to Journey with Christian D. Evans podcast. I'm your host, Christian D. Evans. This next guest is the managing partner of Traction Capital, which has almost $75 to $80 million worth of top line revenue in their portfolio in the holdco. We're so excited about diving into his thesis because before he actually started Traction Capital, he was actually working a variety of finance and investing roles as a VP of finance in several plastic manufacturing businesses and a consumer products e-commerce business. And because of this, the way they analyze and look at deals, they're very industry agnostic. And so we're very excited about having him on, unpacking all of his thought process, the way he looks at deals, how he's able to underwrite them, and not in a specific vertical, but really agnostic, but also very, very successful in the growth. Please welcome my next guest, the managing partner of Traction, private equity firm, Justin Turner. How you doing today, Justin?
I'm good, Christian. Thanks for having me on.
Man, I'm looking forward to this conversation because, you know, what I found very interesting right off the bat is you guys have a very unorthodox approach where you're not coming in the typical private equity where, hey, deploy capital, you know, acquire that company 5 to 7 years and exit, right? So, Justin, was that at the beginning of Traction, when you first established it, built it, that became the DNA where it was like, I want to buy it and I want to hold it for a longer time horizon. Where did that DNA or that approach come from?
You know, I think we've definitely had that approach from the beginning. You know, I think we were influenced early on, you know, by some of the, you know, there's certainly some larger groups doing similar things to what we are that have that permanent approach. And I think, you know, hearing some of their stories, seeing some of the larger, you know, more famous holding company structures, and just the cost of doing a transaction, both from a time standpoint, a tax standpoint, you turn off that compounding engine when you sell something. So, you know, I think from the beginning we've had the mindset of we want to be, you know, multi-decade owners of these businesses. And, you know, not saying we'd never sell something, but our goal going into it and our goal when we're working on strategy is, you know, how do we build a long-term compounding business that generates, you know, increasing free cash flow over a multi-decade hold period.
Where did you see that compared to the typical orthodox, you know, 5 to 7 year exit? Did you find that having it more of a multi-decade approach is, like you mentioned, more compounding effect, and you saw, like, obviously the numbers work in that favor? What was your rationale? How did you come to that conclusion? I'm just curious.
Yeah, I think, you know, you look at I think AJ Wasserstein has a great article on the compounding side of things and the long-term benefits of, you know, a 20-year hold versus a 5-year hold. You know, the other piece of it, I think that resonated for us and for me, you know, I worked in private equity previously, and it can be, especially with the size businesses that we're working with, it can be a challenge to really come in and try and drive a ton of changes with the goal of driving, you know, rapid increases in profitability leading to an exit in 3 to 5 years. That can be really hard on the team at these companies. And I didn't love that experience when I was in private equity because I felt like, hey, like there's real people that are involved in running these businesses, and you can't just run them over because you're trying to achieve a certain thing. And there's traditional private equity has generated, you know, great returns for LPs over the last 15, 20 years. So there's not one right answer to how do you generate, you know, wealth and returns. I think the longer term approach, you know, resonated with us and how we want to treat people, how we want to treat the employees, how we want to treat the business owners that we work with. And I think, I don't think we realized this as much going into it, but that longer term time frame has really resonated with the entrepreneurs that we've partnered with as well. You know, I think we're a great fit for companies that care about, what happens with their business, with their employees, with the community that they're in after they sell. We're probably not the greatest fit if somebody is just worried about maximizing the dollar that they receive when they close. And so having that long-term mindset means you have to be focused on the culture side of things. You have to be focused on the employee retention, the employee teaching and training, so that you're continually elevating the teams and giving them more opportunity once you make that investment. Because with small businesses, the owner and the couple key employees really are the business. They really are key to making that thing go. And so you have to figure out ways to continue to take care of them and continue to provide opportunities for them to earn more money, learn new things, grow in their responsibilities. I think having that longer term hold just resonated with us on how we want to do business, how we want to treat people. And we've only been doing this for 4.5 years, so we're still very, very early into this. But so far, I think it's worked out well.
Well, that's why it's so impressive. That's one of the reasons why when I have you on is not only because you're really relatively newer, but the reality though is you've been able to hit massive acquisition and massive scale pretty quickly. 75 to almost a $80 million run rate top line. That's very impressive. And I wanted to kind of dive into your thesis a little bit, Justin, because some of your portfolio companies in acquisition, I may miss a few, is like C Western, firefighting equipment, Swag, which is sales channel, directed business, home hobbyist. You also have Tony Lynn Paving, and then as well as Stumpton Mattress. So a lot of different, basically what I'm saying is a lot of different verticals. So that tells me, Justin, when you're looking at a company, you're not looking at industry specific, you're looking at a methodology or principles and seeing if these specific companies hit that checklist, if you will. That traction obviously has that methodology and that filter process. Could you unpack the way you and your team look at a lot of these deals, how you come to the conclusions that, okay, hey, this company is worth investing? What do you look at? What are some of the green flags and the red flags? Let's dive into your methodology and your principles on underwriting a deal.
Yeah, again, we're happy to talk about each of those specific ones and what we liked, and the two new ones that aren't on our website yet either. But you and I chatted a little bit offline before starting. We really try and have a lot of price discipline when we're going into these things. I think you can de-risk yourself a lot based on how you buy these and not overpaying for them. And so there's been some great businesses that we've seen that we would have loved to own, but we didn't feel good about trying to own them at the price that they were going to trade for. And I think that's great for the seller. Whenever we have to have that conversation with a banker and say, hey, we're out because of the valuation side of things, we wholeheartedly mean it when we say, hey, we hope you get that outcome for the seller, because that's an amazing valuation and legacy that they're going to get to have based on that selling price. So we're happy for the sellers. We would love to be owners of that business, but at the price, we don't think it's appropriate for us. With C Western, that was our first deal, and so did we go into it thinking, hey, we want to have an investment in a public safety distribution business that sells equipment to fire departments? We weren't looking for that business. But the more we dug into the industry, who the customer is, it's very easy to be supportive of firefighters, especially firefighters that are in your local community. It's not an industry that's going to be going away. There's going to be an increasing amount and increasing dollars flowing to the public safety side of things. I think we got fortunate. We bought a business that had been around since the 70s, and we have a great CEO of that business that still owns a chunk of it even after selling to us. I think price discipline drives a lot of it. When we're thinking through, when we first see a teaser on something, while we're not industry focused, we definitely try and get up to speed on an industry, and so we have kind of an industry map that we go through when we're diving deep on something, we want to understand, what are some of the major deals that have happened in that industry? If there's any roll-ups that are happening in that industry? Who are investors that we know that are investing in that industry? We try and understand, what are the different business models that operate, in a given industry, and how do businesses actually generate cash? What is that process, and how do different companies in the industry, go about that? And if we're looking at a specific company in that industry, how does their business model compare to some of the highest performing companies that are in that space? We look for, regulatory headwinds or tailwinds. And so we come back with a 2 to 3 page document that outlines kind of high level, what's happening in that industry, who's buying things, what are some opportunities, what are some risks. So while we're not, focused on any specific industry, we do try and dive in and become at least like a little bit knowledgeable about it once we really start spending time on a deal.
So when you're looking at these businesses, it's almost like you're looking for not the perfect little shiny thing where you're going to get the top dollar. It's really you're investing into a company at the really good price and expecting a value add almost approach when you walk in and acquire that. Is that correct, Justin?
I mean, we do want to figure out how to grow them for sure. We're not going into it saying, hey, how do we, change certain things to drive a higher multiple if we want to sell. But we do come in and think about, hey, where do we need to improve the processes? Where do we need to, clean up their financials and financial reporting? Where do we need to add people to the team? A lot of times with these small businesses, they're operated, very leanly. The owners, while they may not be experts financially, they understand that every dollar that they're writing out as an expense is a dollar that's not ending up in their bank account at the end of the day. Not that that drives everything that they do, but they're very aware of the costs and the margin. And so a lot of times with these businesses, take a business that's generating $2 million in EBITDA. On our side, when we're modeling it out, we're probably saying, hey, there's an extra $250,000 or more of expenses that we're going to add to this business because they need to build out their team more than they have right now. And a lot of that is, the owner's wearing multiple hats. The owner's wife is maybe getting paid, maybe not, but is probably doing something in the business. And a lot of those things just have to change once they sell. They're not going to have the same incentive to do everything that they've done in the business. And so we know on our side, we've got to model in more costs for maybe a GM, maybe a controller, maybe, XYZ person to take something off the plate of the owner or the owner's spouse or somebody else that's going to be, stepping out of the business.
So you almost experience a J curve a little bit when you acquire these.
Oh, for sure.
And then obviously
I think on every deal we've done, maybe other than one, there's been a J curve.
So
sure.
with that being said, let's dive into that J curve kind of timeline. Is there something that you kind of a contingency and say, okay, hey, within 6 months, 8 months, we anticipate that kind of down, and then we're going to be pushing back around forward and really hitting back at a foundation level and being able to scale? Or is that more of anticipating almost a 12-month kind of time horizon, timeline for that J curve? What does that look like, Justin?
I think it's different for every business. I think, and also the size of the business. A company that's $3 million in EBITDA that you need to add $250,000 in expenses. If they're on a historical growth rate of 10 to 20% a year, you're probably going to make that up in the first year. So you're probably at the end of the first year of owning it, you're going to be back above the EBITDA threshold that you bought it at. If it's $1.5 million in EBITDA and it's been growing but not growing a ton, adding $250,000 in expenses, you may not get that back for 2-3 years, depending on the business. We like that J curve period to be as short as possible. The steeper the better on that, but it's very business dependent. We try and keep it to a minimum, but it depends on
a lot of factors. So let's dive into C Western and help me understand how you guys looked at that, because what I found in underwriting any business, all these numbers and all this data tells a story. And obviously with your experience and expertise, you have to identify what that story is telling you with those numbers, right? And so now when you're looking at companies, obviously some people I've talked to in private equity, they gravitate more toward the SaaS world, mainly because the margins are pretty high. It's pretty defensible depending upon what industry you're in or what kind of product that looks like and so forth, as well as the MRR and the ARR is really sexy as well. With that being said, let's talk see Western, okay? What did you see that really kind of said, okay, hey, I see this? I think you mentioned a few things there. Was a defensible moat where, hey, they had some enterprise contracts. What else did you see that you said, okay, hey, you know what? We see this long-term, a good value add, but also long-term growth, because that's like you mentioned. So help me understand how you thought that through, and then obviously you take that same. It's very contextual, I know, depending upon each business, but let's start with C Western there.
Yeah, we started by trying to understand, the industry a little bit. It was, very easy to be like, oh, okay, I get it. They sell equipment to fire departments. So then it was trying to understand, okay, who else does this? What is the market like? How long is the sales process? And so we pretty quickly were like, okay, we like the end customer. We feel like that's not a customer that's going away. From a process standpoint, their back office was pieces of paper that moved in stacks through the back office and, eventually ended up with, some information going into QuickBooks. So we knew there was a lot of opportunity to clean up the accounting side of things, to help get a better understanding of, what are our best performing products, what's the trend with products, where are our margins actually at. The other piece of it was owned by a brother and sister. They were the children of the founder. The business has been around since the 70s. And we, got a good sense from, spending time with them and some of their key employees that, they were really reticent to spend the money necessary to invest in the infrastructure, invest in the systems to be able to expand the business. So when we bought it, it was pretty much exclusively Washington and Oregon where they served customers. And so we felt like there was the ability to implement an ERP system to make it so that we could potentially scale the geography that we serviced. The challenges when we were first looking at it, they had historically been kind of the sole distributor in their market for a certain product line that they had, and call it 6 to 12 months before we got introduced to it, a very large competitor in the industry was also granted the territories that they had. And so we knew that there was going to be competitive dynamics. We knew that there would probably be, margin compression, given that they wouldn't be the only, distributor in their market. So it would be a more competitive process in selling to these fire departments. But we felt like there was the ability to ultimately grow, the gross margin side of things by expanding the territory, even if the current territory was going to, have some margin compression. And we really liked, the sister wanted to transition out. The brother wanted to stick around and continue to run the sales side of things. He ultimately became CEO of that business for us. And so we've been able to, it hasn't been all up and to the right, but we've been able to, transform that business since we've owned it. We've got an ERP that runs the business now. We've got, software tools that we've built that make the salespeople's lives a lot easier. And we've been able to, utilize those systems to be able to go from just selling in Washington and Oregon to being in 9 of the Western states with our sales team and products. So that one worked out. I think a lot of, like, when we put together our package to go out to investors on, hey, here's where we think the growth opportunities are, we've been able to execute on most of those, which doesn't always happen. But yeah, that one's worked out pretty well for us.
That's incredible, and that kind of helped me understand a little bit what you were looking at. Now, I do know the acquisition, getting to that goal line, is really only the beginning. When you acquire, then it's actually about scale and really implementing it. So obviously you do a lot of underwriting. We could dive into that a little bit further, but I really want to talk a little bit about once you acquire it. Justin, you and your team, you guys have an incredible team of, years of experience, from a CFO to another individual that's been in the private equity world working with Blackstone. So a lot of big players on your team at Traction, which is really incredible. But Justin, when you're looking at, let's just take C Western or whatever, where, when you're looking at that company, there's obviously the marketing, the sales, the operations, the systems, the processes, the execution, the growth trajectory. A lot of private equity very well known for, piling on a lot of debt, leveraging that debt, and really obviously maximizing it. That's their growth. Since your growth strategy is tremendously different, you have a longer time horizon, which is awesome. You could build a better structured business. Some in the Silicon Valley structure, they always think grow at all cost. And I think your approach, and I want to obviously just make sure you correct me if I'm wrong, your approach is grow at a consistent pace more than grow at all cost. Is that correct, Justin, in regards to that strategy?
Yeah, we want to, more than just top line growth. We want to drive free cash flow growth. And so, a big part of our job is understanding where do we actually generate margin in the business, and is there products that maybe the team feels like are really high margin, just gut feel on it, that isn't actually driving the margin that we thought. So we do want to grow, but it's definitely how do we grow profitably, and we kind of internally target 5 to 10% a year organic growth within the existing portfolio. We've certainly had periods of time where some of our businesses have done way more than that, and that helps you improve your systems, because everything breaks when you go through a ton of growth. Our swag business grew 50% in 2020, and I wouldn't say every system broke, but a lot of things broke and had to be rebuilt, and had to refocus on, okay, what does this system look like if we grow 50% again? If the business is twice the size, does this process that we have actually work going forwards? I think you try and understand the business as best you can during diligence, and then once you actually own it, you actually start to understand what the business is and what it actually does, and the dynamics of each business. We talk about, buying the company is the easy part. Once you own it, the actual hard work starts.
So let's talk about that, because, and you mentioned this, and I want to kind of loop back around on it. Obviously, skeletons in the closet, right? There are certain, when you acquire a company, maybe it might be 6, maybe 12 months down the road, all of a sudden, maybe retention, maybe some employees decide to leave, whatever. Like there's something happens, some sort of skeletons in the closet, and it's really a matter of how do you pivot, how do you adapt, and obviously at the macro economy right now we're fighting potential recession. A few years back we were fighting against COVID, right? There's always something happening, right? So it's really a matter of navigating these portfolio companies in uncertain times, which is all the time. So Justin, when you're navigating that, how do you guys look at that? What do you guys do? Obviously, you mentioned you really want to streamline the business, increase that margin. It's not really about the top line growth. It is part of that, but by increasing the cash flow, obviously you're able to kind of compound that effect and growth. So help me understand how you navigate that, and maybe certain circumstances or a situation or story, Justin, you could share with our audience where you did have a skeleton in the closet. It's shown itself, and you're like, okay, well, this is what we have to do. And you just kind of run with the punches.
Yeah, I think there's always certain things that you find out after you buy it that maybe were different than what you were led to understand or believe about the business, before you bought it. One of the bigger challenges that we had early on with our paving business was an employee exodus after we bought the business. And the difference in culture from what we understood about the business the day before we closed versus, being there the day after you bought it was very different. And so we, myself and one of my partners are there, 6 in the morning, the crew's getting ready to go out to the jobs for the day, and, we're meeting everybody for the first time. Some of the employees, this is when they're just now finding out that the business sold, which, there's a lot of nervousness and sometimes, resentment when companies find out that the business is sold. And, with that business, it was apparent from that first morning, hey, we're going to have some challenges on the people side of things. And we had, some really key employees that quit, within a week after we bought the business, and kind of just got to roll up your sleeves and, okay, this is our new reality. Like, we got to figure out how to solve it. So yeah, there's always challenges.
How did you solve it? How did you solve it, if you don't mind me asking, Justin?
It took a long time. It took a long time. We've been able to, recruit and bring in some great people to the team. And I would say, we've owned that business for a little over a year and a half. It probably took us a year to work through a lot of that. And even now, we're still bringing great people onto the team and trying to get better there. But it's tough to change a culture. In our market, it's been tough to find really skilled leaders on the paving side of things that want to work in a non-union business. You lose a lot of employees to the union side of things because of, the perceived benefits of going that route, which, whether that is true in reality, I question that. But, we've had a lot of people turn over in that business. I think we've finally gotten to a place where we feel really good about the team that's there and are excited about, the opportunities with that business going forward. But it's a challenge, and there's no silver bullet. It's easy to say, oh yeah, we'll recruit somebody. Okay, sure, you might be able to do that. But those people, key leaders, are not just walking around looking for jobs. They're not, knocking on your door saying, hey, I would love to come work with you, and I'm really good at what I'm doing. So it was a challenge.
So in that acquisition, as well as during this timeline, what were the positives and the negatives that you learned from it that obviously you're going to apply those boundaries or systems or thoughts to the next acquisition that may be in the same industry?
You got to, as best as you can, you got to try and meet, as many people within the business as you can. And sometimes owners are really hesitant to, let people in that they want to sell, which we totally understand. We push really hard to be able to meet folks, and that usually happens right at the end of the process when everybody's, hey, this is going to close. So it's one of the last things that we do as part of our diligence process is get to spend some time with people other than the owner. And part of that is, you've got to build up the trust and the relationship with the seller so that he feels really comfortable about bringing you in as a, outside third party that's now going to be, owning and ultimately responsible for, what happens with this business. Meeting the team, trying to get a much better understanding of what the culture is, and that's really hard to figure out. You try and have folks talk to competitors, you try and have folks talk to customers, without giving away, hey, we're looking at buying this business. So there's firms out there that'll help you with that kind of industry research and customer research that can be done in a way that doesn't give away that the business that you're talking about is for sale. And you start to get a feel for it once you've done a number of these deals. You can start to get a sense for, okay, the owner's saying this, we trust and believe him. You can get a sense for some people, you ask certain questions and they shy away from it. You're like, oh, we need to highlight that in our notes so that we remember to circle back and try and get a better understanding there. But some of it comes down to just experience. You got to go through a number of these, and we still, I mean, I would say we're trying to improve our process every time we do a deal, and we certainly don't, we're definitely not perfect. We definitely still make a lot of mistakes and sometimes some rookie mistakes, but you try and get better and improve your process every time you go through it.
Yeah, I appreciate the humility and the transparency that you shared, because I have someone else that was on my podcast, and he said almost the exact same thing in regards to navigating. We talked about all the underwriting of the metrics and the KPIs and all the, the financial side of things, and then we looked at the culture and we didn't really do too much, or maybe it was like we didn't navigate that properly the way we should have. And so I appreciate it, but obviously you learn and you figure that out, and that's just awesome, Justin, to see the evolution. I want to ask this because I've talked to every private equity. They all have different ways to approach their portfolio company. And what I mean by that, obviously you have a very hands-on approach, but how so? How much? As in the operations, the systems, the processes, or do you like to normally find a team and that obviously is really good at that industry, almost like that Warren Buffett approach, where, hey, they've already got the team established, they already know the ins and outs of that, they know ins and outs of that business, and then basically you're the holdco, and you take more of a passive role, but you're the one that's able to help them facilitate maybe different ways of thinking about the business, et cetera. Or do you guys take very active positioning? It sounds like you take a very active positioning even when hiring or firing in your portfolio. What is your approach?
I would say it's in the process of evolving. I think early on when we, bought our second business and our third and our fourth and started to have more than just, one or two in the portfolio, I think we thought initially, and we executed on this initially, of, hey, we want to try and centralize some of these things. And in our mind, a lot of it on the finance and accounting side, the insurance side, the benefits side, we said, hey, we know these are pain points for these businesses. We felt like we could hire, maybe a higher level of talent at the traction side of things and split them amongst multiple companies to help. We're now pivoting back to a much more decentralized approach on that. So we're in the process of recruiting, controllers and CFOs across the portfolio. Outside of the finance and accounting side of things, all of us have been, of the partners, all of us have been operators, all of us have worked in businesses, all of us have been responsible for payroll and shipping products out the door and making sure the business of business actually happens. And so we're happy to roll up our sleeves. We are, as quickly as possible, trying to make it so we don't have to do anything, day to day, week to week in the business. We want to be a resource. We want to help. We'll help, find the accounting people. We don't want to do the accounting on the traction side. We will help bring people in. We feel really, strongly that we can help you find the talent that you need there. Some of it comes down, we don't want to be, we'll roll up our sleeves, but we don't want to be the operators of these businesses. We're not experts in the industry. We're not staffed to deploy people into full-time positions. And so it comes down to, can we evaluate the team? And some of that evaluation happens, after we close. We bought a business where the owner said, hey, I want to work for a year, but then I want to be done. So we need to find somebody to come in and run it. And we said, hey, we agree. We're fine with you just working for 12 months, but we're not going to hire that person until we've owned the business for a few months so that we can actually have somebody from our team there, almost every day, interacting with you, interacting with the team, and coming up with, hey, what do we think the person that's going to take your job, what do they actually need to be good at? What do their skills need to be? And so we've had some success with that of, hey, we'll come in, we'll spend a lot of time in the business the first few months, and then we'll help find that key person that you need. So some of that, evaluation happens after we buy the business. And I think that the ideal role for us now is being a resource on problem solving, projects, hey, I've got this issue. How should we try and solve it? We help come up with incentive and compensation plans for key employees. We've had, with one of the businesses we just bought, the owner came to us saying, hey, I want to make this key hire on the sales side of things. Here's his expectations for comp. How should we put that together? And so we helped them think through and put together an offer letter that we think aligns what we want to achieve and the outcomes that we want to have happen with that role, but also if that person is successful, gets them above and beyond kind of where their expectations were on the compensation side. Looking at add-on acquisitions, looking at different growth avenues, we love to help out with those things. But I don't think we can be effective if somebody from our team is key to the operations, going forwards. And I would say earlier on, we were way more involved. We're trying to fully build out the teams so that we're not having to do that, because I don't think that scales as we acquire more businesses.
So that's really cool, and you're in the evolution phase right now, and you're seeing that, and obviously building out and sustaining those teams and the importance of those. And I appreciate kind of explaining.
Very
I
much
appreciate
so.
explaining.
Very
so
much so.
Let's talk a little bit about this, Justin, because there is this like talent acquisition plus obviously the product and the R&D and so forth and all that fun stuff to really build it out. And you guys want to be in that CEO role where it's more that visionary, where are we growing it, and there's obviously different phases of that. Let's talk about it. When you acquire a company, I would imagine right off the bat, you're looking at the numbers. Okay, hey, we can implement an accounting software. We can go ahead and get rid of some people. We can hire better acquisition, take, kind of really increase those margins. And then like phase two is, okay, hey, are we going to grow through, shoving more money back into sales and ads to really be able to, acquire more clients, or grow through M&A? What does that look like, that evolution when you've actually acquired it? What are those stages? And I'm talking, let's picture out a portfolio company that you acquired 5, 10, 15 years. How does Traction Cap, you guys look at that in regards to that length of the company? I would imagine there's certain KPIs or certain metrics that you're looking, and I'm not talking just in a 12-month. I'm talking over a 5, 7 year period that says, hey, this is our phase 1. We get that dialed in. Phase 2, boom, we get that dialed in. Phase 3. And then go from there. Just lay that out for me, Justin.
Yeah, I think there's a couple different stages in there. Yeah, we want to be, the board of advisors. We want to be a resource. We want to have great CEOs that are responsible for that business, that own everything that happens with that business, and we want to be an external resource that can help, with whatever challenges they're having, can help them look at acquisitions. We want to really get to a point where our job is hiring great leaders, sometimes having to fire leaders, unfortunately, setting kind of incentive and comp plans for our CEOs, and then capital allocation. Where are we going to buy more companies? Where are we reinvesting in the businesses that we do own, on whether it's CapEx or M&A? And so, we think the first, call it, 6 to 18 months once we buy a business, there's not a lot of things we're really going to try and change in a meaningful way outside of probably the accounting side of things. And the accounting side needs to change largely just because, we've got to get it to GAAP. We've got to get a team there that can actually, accurately report the financials monthly. And that may mean different things at different businesses. Some of the ones we acquire, they've got a great team, does it by GAAP. They know how to do it. They may just need, hey, like the expectation is not 30 days on close, it might be 15 days. So how do we change some of the process to make that happen? But until you really understand the business, it's tough to start going after a lot of those growth drivers, in our opinion, with these small businesses until you've owned it for at least 6 months, because there's so many things that break. There's so many things you have to navigate through once you actually own the business. I apologize, I'm kind of meandering on your question. We feel like Traction itself is a startup. Like, our business is 4.5 years old, And in some cases, we're buying businesses that have been around since the 70s. And so on the one hand, we have these businesses that have a very long history, a very deep culture, tons of industry experience. And then we've got Traction that's 4.5 years old, that's 7 people, and we're still very much trying to figure out, like, how does Traction work? What are we actually doing? So it's I don't know how to accurately communicate that piece of it, but we are very much in the early stage with what we're trying to do. We are still trying to figure it out. I think one of your questions was the long-term growth piece of it. Part of that, we want to be organic with the core business that we're buying, and then, where it's appropriate, we want to do, add-on acquisitions as well. One of the 2 we just closed this year is we call it an add-on. It's a bigger business than the one we already own, but we've owned Tony Lynn Paving for about 1.5 years now, and we just bought a business called Ground Up Road Construction. And we really like the, call it, infrastructure services side of things. When we look at industries, like, we don't think roads and paving are going away anytime soon. And I think that, as we think about macro events, spending for infrastructure, spending for roads, highways, utilities, that's not going away. There's an increase on the government side of things to spend more money in those areas, and we think there's the ability to build a really big business in that space. Our existing paving business is truly just a paving business. We do roads, highways, driveways, parking lots, airports. The business we bought is on the grinding and soil stabilization side of things. So we think there's the ability to cross-sell and provide a broader suite of services to a lot of our existing customers on both sides of things. With the restoration business we bought, we knew going into it that add-on acquisitions would be a big part of the growth strategy there. And we've got a CEO that we partnered with there who is very driven and growth focused and is very entrepreneurial. He wants to go out, start this new thing, build this new thing, and then build the team that makes it keep going so that he can get on to the next kind of growth initiative. So we've owned that business for it's April 6th, 2.5 months. We've been out on multiple site visits for add-on acquisitions already. We've got an IOI out on an add-on for that business. And so with that one, we think add-on acquisitions are going to be a huge part of the business. That business had really good operating systems already. We have to clean up some things on the accounting side of things, but not anything major. So we felt a lot better about coming in and trying to drive a lot of growth initiatives early on because they had a lot of the systems and team already in place that they needed. So it really depends on the business. With C Western, we knew long-term growth was going to be how do we expand the geography that we cover and how do we add to our product line. With Swag Off-Road, it's, hey, how do we continue to develop new products to push into this channel because we've got a very loyal and passionate customer base, and so we need to figure out what other products do they want to buy from us that we can push out to the market. So it's a little bit different for each business, and that's part of the fun of it is understanding the business that you now own, the industry that you're now a part of, and figuring out what works best for the business on the growth side of things and what are the appropriate things to go after.
Well, I appreciate, Justin, your humility. Obviously, you say Traction Capital is still navigating the waters, but it's so interesting that you say that. It's been 4 years, but you've been able to acquire, top line almost, a 70, 80, 90, $100 million portfolio, which is very impressive. So that growth is quite impressive. So even though you're humble, I just want to reiterate that you guys have been able to establish an incredible team already. But also, I do acknowledge where it is so contextual. That's why it is these conversations, these dialogues. It's very interesting. That's why I wanted to learn how, you and Justin and Traction Capital, how you guys look at these businesses and obviously playing chess, if you will, and putting the puzzles, the pieces of the puzzle together to say, okay, hey, this is where we're at with this company, and there's alignment in our portfolio companies, and there can be upsells, and even within acquiring other companies that maybe, like you mentioned, on upsells. What else do these customers want? What else do they want to? How can we serve them more? And you just mentioned even see Western, which is a really good example of what other products, so we can increase that LTV of the customer. So which is really, really incredible. I want to ask you, you said you gravitate a little bit toward, constructural, services, which I definitely understand. However, though, on that point, I would imagine there's a lot of capital expenditures, a lot of equipment that is needed to, so that's obviously the margins then are kind of light. Unless I'm mistaken, unless you see something different, you see more of, hey, you know what? We know this is a good moat, because again, it doesn't matter what industry, if it goes up or down, people are going to be still needing to buy this because it's constructural. So is that how you look at it? Or, because I would imagine, like I just mentioned, it is very, you get a lot of equipment, a lot of assets, but it's very capital expenditure on the front end. So how do you think through that process, just specifically in both those acquisitions that you mentioned?
For sure, CapEx is definitely a big part of those businesses. With the first one we bought, Tony Lynn Paving, we knew that going in. One of the things that was great about that business, at least for the first year and a half, 2 years of owning it, the owner had spent a lot of money in the 2 preceding years to us buying it on new equipment. And so in our model, we felt like, hey, outside of maybe some lighter duty trucks, there's probably not going to be a ton of major CapEx for the first year or 2 in the business. And that's proved out, so far. With the add-on acquisition we did, we worked with the owners a lot on the front end before we even had the LOI signed of, hey, we can see that you guys are spending, X percent of EBITDA every year on CapEx. So when we think about valuation for that business, we're going to be looking at EBITDA less CapEx as the number that we're working off of. And it took, a lot of conversations, but they intuitively knew as the owners, yeah, that's right. Like we see on paper that we made X, Y, and Z, but really we're spending a big chunk of that every year on, whether it's growth or maintenance, we know that we're spending X amount per year on the CapEx side of things. So it's definitely something you have to plan for. We assume 20 to 25% of EBITDA is going to have to be plowed back into CapEx for that business. Some of it's growth, some of it's maintenance. And so, yeah, I mean, that's definitely our most capital intensive business that we have. I think you have to try and price your work appropriately so that you're still making margin, on top of that. But they can still be great businesses. They're not the traditional, like, hey, this is what a search fund is looking for. Like, it's not all reoccurring revenue. It's a lot of contracts. It's some even construction, which it makes most searchers instantly run away. We feel like if you price the business like appropriately when you buy it, those can be great. And plan for the lump. Like, you're going to have in construction businesses, you're going to have huge years. You're going to have really lean years. Like, so if you can buy it appropriately and structure it appropriately, I would buy those businesses all day long.
I appreciate that. Yeah, because I'm not too familiar with the construction side, so I just wanted to ask you that because I do know like it is very capital intensive, but the way you look at it is you're doing your underwriting, and then as well as your valuation is kind of bringing that into context. So you're anticipating that, which is really good. I appreciate you kind of emphasizing that, Justin. I really like you being on our podcast, but I want to ask before I let you go fully and being able to understand. You've obviously been able to acquire incredible holdco, six acquisitions in a very short period of time in retrospect. And now that you've been able to acquire some of the money and revenue and so forth, and you're getting some things, how do you guys like to allocate that capital? And what I mean is new acquisition, new portfolio, and a new venture, new business, or putting that money back into certain companies, really helping them grow and scale, and restructuring it, or obviously sending it out to dividends with LPs. How do you guys look at that in regards to when you guys do have that cash flow? Where to allocate that and the capital allocation aspect of it?
Yeah, no, we definitely evaluate, within the business that's generating the cash, where are there opportunities to deploy that to generate, a return on that invested capital. With how we structure our investment, there are, distributions that we pay out to LPs as a percentage of their equity that are in the deal. Again, we're 4.5 years in, so it's not like there's been major distributions that have happened for shareholders. There's been some, which is great, but we really want to, as much as we can, keep the free cash flow inside of either the business or inside of Traction to be able to go buy, whether it's new equipment, go buy add-on acquisitions, or bring it up to the Traction level and deploy to go find new portfolio companies for us. We talked earlier about the compounding side of things. We want to keep as much of that cash as we can so that we can go buy, the next thing that we want to own for the next, 10, 20 years. So it's, again, it varies business to business. You have the, do we go buy something? Do we buy more equipment? Do we pay down debt faster? It's a balancing act, and it's a discussion within each business for sure.
Yeah, I'm always curious. Everybody, when you have the money, it's like, now where do I allocate it accordingly? Do we? Because the compound effect, I think that's why Warren Buffett, a lot of people don't understand, he doesn't pay out dividends and any of that. That's why he just keeps gobbling money and money and money, even for his shareholders and so forth. So that same structure, you want to keep most of it in-house, so then of course you can allocate. And obviously you do some payout to LPs and so forth, but depending upon each.
Yeah, we do distribute, some out in excess of whatever tax distributions have to happen. But yeah, we want to compound. We want to put that money back to work, to generate returns for us and our LPs. And again, we're 4.5 years in. Like you say things like 80 million. And like I hear that, and I know that we've done that, but I'm also like, well, we're 4.5 years in. Like we've barely just gotten started. Like we haven't even gone through a full life cycle on anything yet. And I tell people all the time, like we'll find out if we're actually any good in 5 to 10 years from now. Like for the most part, we've been investing in an economy that's been up and to the right. There's been some blips along the way, but we'll find out if we're actually any good in 5 to 10 years.
Just, I love it, man. And obviously you got a good team as well. For those that want to reach out to you and be part of what you got going on, learn a little bit more about Traction Capital, a little bit about you and the team and what you guys got going on, how do they reach out to you, my man?
Yeah, I'm active on Twitter as I consume a lot on Twitter. I'm not a content producer on Twitter, but I'm on there. Send me a DM. I think my email's on our website. Shoot me an email. Always happy to chat. I've had a lot of people that, early in my career were tremendously helpful in, being willing to spend, 30 minutes with a young guy that was trying to figure it out. And even, today there's companies that are way further ahead of us that, are kind enough to let me ask, them some questions so we can try and learn and get better. So happy to, pay that forward to other folks that have questions or trying to, figure out how to buy a business, trying to figure out how to buy multiple businesses. Want to be helpful to those that are trying to navigate this, entrepreneurship through acquisition, holdco, search fund, private equity side.
Awesome. And guys, those links are in the description. I'll put all of his Twitter, his email, his website, and his LinkedIn down there so you guys can take a look. And I would highly recommend connecting with him. I'll put his website because they got all their portfolio companies on there as well, so you can get an idea of kind of his thesis and alignment and where it is. Obviously, we talked a lot about it today. Justin, again, I really appreciate being on here, just sharing your knowledge. I really appreciate your humility. Obviously, you've done very, very incredible things. I know you keep saying just 4 years, but I am astounded by in 4 years how much you've been able to acquire and really scale up to the right. And but I want to ask you, you've done very well for yourself thus far. You have a large trajectory where you're going. What, if you think about that young Justin, to now, the Justin you are now, what insecurities did you have to overcome to become the successful Justin Turner that you are now today?
That's a great question. Well, one, I appreciate you having me on. This has been a lot of fun. I think early on in my career, I was young, and I also looked really young. There was times when I was on the investment banking side of things where, we'd be in board meetings with the CEOs and owners of these businesses, and the CEOs would flat out be like, why is this kid in this meeting? And I felt from early on in my career like I have to be the most prepared, I have to be the most knowledgeable person in that room so that you can't hold anything against me even though I'm young. And so early on in my career, I worked, really hard for that to be the case. I wanted to be able to add value to the conversation, add value to the businesses that we were working with, even though I was, really young and really inexperienced. So I'd say that put a little chip on my shoulder. And I think the other piece, I've always been, somewhat entrepreneurial, starting businesses when I was in high school, starting businesses when I was in college. And, traction, I think, is that, scratches some of that entrepreneurial itch for me. It's something that, we started from nothing and, now get the opportunity to work with a lot of amazing leaders across the portfolio and hopefully, more down the road. So it's been a lot of fun. I'm amazed, every time we sit down with a new entrepreneur, hearing their story of how they were, good at making something, good at servicing something or building something. And, for them it was, hey, I think I can make more money starting something on my own than working for somebody else. And I'm amazed by just the amazing entrepreneurs that are out there building businesses that you've never even heard of, that employ 100 people, and it's awesome to hear their stories. So it's been a lot of fun. I've been super fortunate, for sure. It's
been very eye-opening to be on the forefront of that and seeing all the fun creative things. And it's unbelievable how many some of these businesses make top line revenue of 8 figures. Is like, I've never even heard of you. This is incredible. So that's awesome, Justin. And obviously the insecurities you had to overcome to become the Justin Turner you are. Guys, that is the managing partner at Traction Capital, my friend Justin Turner. Guys, that is Journey with Christian Evans podcast. Until next time, be uncommon if you can.